Hi, everyone. Welcome to today's webinar, Scaling Up Private Investment in Low-Carbon, Climate-Resilient Infrastructure Through Green Investment Banks. The webinar features new research on green banks from the OECD and is hosted by the Green Bank Network. My name is Doug Sims of CMI at the Natural Resources Defense Council, or NRDC. NRDC and the Coalition for Green Capital are organizing the Green Bank Network on behalf of 6 green banks. Today, we're pleased to be joined by Rob Youngman, team leader of the Climate Finance and Investment Unit at the OECD, to talk about the OECD's recent comprehensive survey of green banks. Before we get started, I want to go over a few things with you so you know how to participate in today's event. You can submit written questions to today's presenter by typing your questions into the questions box of the control panel. We have a screenshot of what it looks like up on the screen right now. You may send in your questions anytime during the presentation. We'd like this to be a discussion to the extent possible. So we will pause midway through the presentation to answer a few questions, and we'll have another Q&A session at the end of the presentation. You can also live tweet your questions if you'd like, and the GBN Twitter handle is up on the screen as well. Before I get to the main presentation, I want to give you a quick update on the Green Bank Network. Since our initial webinar in April, the Green Bank Network has continued to build its infrastructure and increase awareness and knowledge exchange among its founding members and other sectors and other actors in the green finance sector. But what is the Green Bank Network? The Green Bank Network is a standalone, member-driven organization with partnerships with networks of institutional investors, commercial lenders, development finance institutions, and other players in the market. Next slide, please. The Green Bank Network creates connective tissue between green banks to help them collaborate better. Next slide, please. The founding members are the UK Green Investment Bank, Connecticut Green Bank, the New York Green Bank, the Green Fund Japan, Malaysian Green Technology Corporation, Energy Finance Australia, and we're also beginning to collaborate with other institutions with similar missions. It's managed by NRDC and CGC to develop the network. Next slide, please. Since our last communication in April, we've been very busy. The members signed a memorandum of understanding on May 31st, and it announced it at the Department of Energy's and White House's side event at the Clean Energy Ministerial in San Francisco. The event was entitled Green Banks, Green Bonds, Recent Energy Trends for Public and Private Financial Institutions. Rob Youngman presented some research at the OECD, which we'll be hearing about today, and I gave a presentation on the network and moderated a panel that included the Connecticut Green Bank, Masdar City Green Finance Institution, Japan Green Fund, California Infrastructure Bank, and the California Alternative Energy and Transportation Financing Authority, as well as Mark Glick of the Hawaii Green Infrastructure Authority, and Jeff, of course, of Green Capital. Next slide, please. The mission of the GBN, as outlined in the MOU, is to foment collaboration and knowledge exchange between the members, to share best practices and lessons learned, and to benefit from each other's knowledge and experience, to serve as a source of knowledge and network for jurisdictions that want to organize a green bank. Next slide, please. We've been busy putting together our first generation of online tools with a website with initial functionality that includes basic member information and the mission statement of the banks, and we'll be adding functionality in the weeks to come. We've also started a Twitter feed and a newsletter, which was issued for the first time at the end of June. Next slide, please. To figure out what we should focus on among the members, we took a survey, and we've initially gotten some feedback about what to do first. We surveyed the core questions of the Green Bank missions, as well as their marketing challenges, organizational challenges, and their preferred ways to collaborate and receive information. Next slide, please. This is a visual representation of what the green banks have chosen to focus on in the initial areas. We are updating and adding categories to a comprehensive green banking transaction database, which is accessible to members and eventually others. We're developing knowledge modules on specific topics based on demand from the members. Our first area is LED financing for LED conversions for cities. In these modules, we'll collect publicly available information to centralize available know-how in the area. We will then generate additional specific practitioner-relevant information through conference calls and meetings between the network members and other experts, facilitated by the Green Banking Network Secretariat. Lastly, we will capture specific practitioner-relevant information in a format that can be accessed by all members of the network at any time. Next slide, please. Next slide, please. So the areas of information which we've been organizing so far is around reporting, around metrics, around underwriting and technology, and we're building these out in the months to come. Next slide, please. So now I'm pleased to introduce Rob Youngman, who will take us through his presentation on these comprehensive research that the OECD has completed around green banks. Rob, take it away.
Okay, well, thank you very much, Doug, and thanks for the opportunity to join you for the webinar today. As Doug said, my name is Rob Youngman. I'm at the OECD's Environment Directorate, and for the past few years we've been working, well, the past 3 years now, we've been working on the topic of green investment banks, which are a relatively new type of institution engaged in mobilizing low-carbon investment. So I'll tell you about our report today, and hopefully you'll provide a number of questions to get some additional details. So just to start with Green Investment Banks 101, green investment banks are publicly capitalized entities established to facilitate private investment into domestic low-carbon, climate-resilient infrastructure. A reason why the OECD was particularly interested in green investment banks as a new institution is their focus on domestic infrastructure. Flows of climate finance to date have been predominantly domestic, and for private climate finance investments, 90% remained in their country of origin. So this highlights the importance of mobilizing investment for domestic projects, and green banks can be an important tool to do so. When we talk about low-carbon, climate-resilient infrastructure, that can either be to mitigate greenhouse gas emissions, support adaptation to climate change, or both, and I'll tell you more about the specific technologies and categories that green banks look to mobilize investment in. They use limited public capital, and this links to their cost effectiveness and emphasis on cost effectiveness to crowd in private capital, including from institutional investors. I would focus on this last point for a moment. Mobilizing institutional capital from pension funds, insurance companies, and other institutional investors is particularly key to achieving a 2-degree target. And at the OECD, we collect data on institutional investors. We hold events to bring institutional investors together because they hold roughly $90 trillion in assets under management as of 2013, and that's just in OECD countries. Shifting their investment into low-carbon, climate-resilience infrastructure will be critical. We have ongoing research for the G20 Green Finance Study Group on government actions to facilitate institutional investment in this area. We put together a database of deals. One interesting preliminary finding is that green investment banks were involved in approximately 1/4 of the institutional investor deals in the database, and these involved the UK Green Investment Bank, Australia's CEFC, New York Green Bank, Connecticut Green Bank, and Hawaii's GEMS. Green banks aren't the only institutions involved. 7 public financial institutions, including national development banks and export credit agencies, were involved in another quarter of the deals, and MDBs in about a third. But it seems that green banks, since they're much smaller, they're having an outsized impact in this area. So this is something to watch and what makes them so interesting. Next slide, please. So why do countries create green investment banks? Well, you're probably familiar with the new climate economy estimate that $93 trillion in infrastructure investments will be needed in the next 15 years to essentially to meet a 2-degree target, and this includes also investments to meet the Sustainable Development Goals. So there's major financing for the transition and a range of barriers that limit investment. These include the lack of or weak price on carbon, lack of suitable financial instruments that are familiar to investors of the right size, a shortage of objective information, and so forth. Green investment banks can't correct for all barriers, but they can certainly help to address some, and they're doing that today. Green banks tend to focus, they're designed to overcome investment barriers, and they address underinvestment in low carbon climate resilient infrastructure. But when countries and jurisdictions create these institutions, they can do so for a variety of reasons. So for example, in Japan, the Green Fund was created in large part for local development purposes, and there's a focus on community development there and bringing in actors in green finance that otherwise would not be involved, smaller actors. In the UK, emission reductions and meeting their own climate change legislation and targets was the driving factor. In Connecticut, at least one of the elements behind the creation of the Green Bank was job creation. And energy security is important for a number of the green banks, including the New Jersey Sustainability Bank. And that in New Jersey, the focus was on increasing the resilience of the energy sector after Hurricane Sandy. So there's a number of driving factors and range of objectives that jurisdictions have when they create green investment banks, and this is another interesting trait because they're adaptable to different objectives. And as you can see on the screen, there's 13 national and subnational governments that have established green banks and green bank-like entities. And when we say that, we're referring to organizations that have a mandate to leverage private finance for domestic low-carbon, climate-resilient infrastructure, but may not possess all of the core characteristics of green banks that I'll tell you about in a moment. So they've been created at the national level, Australia, Japan, Malaysia, Switzerland, United Kingdom. At the state level, and particularly in the U.S., so we have California, Connecticut, Hawaii, New Jersey, New York, and Rhode Island. At the county level, in Montgomery County in Maryland in the U.S., and finally at the city level, Masdar in the UAE. I mentioned the objectives of green banks are tailored to their jurisdiction. Among the entities that we don't consider in the report, so we sort of draw the line with when we consider green investment bank-like entities. So we're not considering government-sponsored loan programs. We're not considering programs within national development banks or multinational, multilateral development banks. We're not considering R&D agencies and institutions, nor are we considering public agencies that implement national energy plans. And there's a range of reasons whether their focus is international rather than domestic, but mainly because they don't share many of the core characteristics that I'll talk about in a moment. This is not to say that these different institutions aren't important. There are a range of options for governments to consider, and they need to do that in the context of meeting their NDCs going forward. But green banks have a number of advantages that I think are evident in the report, and our goal is to provide governments with relevant information for them to consider as they're sort of confronting this challenge of the transition. Next slide, please. So I mentioned core characteristics of green investment banks. The first core characteristic is their narrow mandate. So although they can be created for a number of reasons and with a number of objectives, their common and core mandate is to mobilize low-carbon investment using interventions that mitigate risks and enable transactions. The second bullet is on their independence. So green banks have independent authority and flexibility to design interventions based on their deal-making and sectoral expertise, typically gained from experience in the private sector. Some of the entities on the previous screen, such as the Swiss Technology Fund and Green Tech Malaysia, we refer to them, and they actually are comfortable with this, we refer to them as green bank-like entities, because while they may use similar interventions to other green banks, they don't have the independence and flexibility to select and structure different interventions. They also, in those two cases, they both focus more on innovation and technology companies than other green banks, which are more exclusively focused on facilitating deals. With respect to additionality, for example, the New York Green Bank must show how a transaction would not have occurred without their participation, and this is the case for I believe, all other green banks. In terms of cost effectiveness, some green investment banks need to be profitable, are required to be profitable. The UK Green Investment Bank notes that it must invest on commercial terms and has to meet a minimum 3.5% annual nominal return on total investments after operating costs but before tax. The New Jersey Energy Resilience Bank will consider providing grants, in contrast, in the form of loan forgiveness, and is not required to be profitable, so we consider it to be a GIB-like entity. NASDAR Clean Energy supports early-stage technologies like CCS and is therefore a kind of hybrid between a green bank and a technology support program. Finally, accountability. Green banks have in common this devotion to reporting their results, and this is often part of their enabling legislation, a condition of their creation. And they report on various performance metrics. Leverage ratio is one, not the most important, but it is one that people often focus on. The UK Green Investment Bank has reported a 3-to-1 leverage ratio since its inception. Australia's CEFC reported 1.8-to-1 in its 2014-15 financial year. And they have different metrics, but also often look at, for example, jobs created, greenhouse gas reductions, et cetera. Next slide, please. This is going back to the question of why jurisdictions are creating green investment banks. And I think something that I like to highlight. So this is taken from the IEA's World Energy Investment Outlook from 2014. And this is looking at a 450 scenario, which is essentially to meet a 2-degree target. It's worth remembering that the Paris Agreement aims to strengthen mitigation efforts to hold the increase in global average temperature to well below 2 degrees above pre-industrial levels, and to pursue efforts to limit the temperature increase to 1.5 degrees above pre-industrial levels. So our shorthand for 2 degrees may not be sufficient anymore, but what I'd like to highlight here is when we look at low carbon generation, and that in this in this report includes nuclear and CCS as well as renewables. We need to increase low power generation by an order of 3 to get on a 2-degree target in 2035. And for energy efficiency, it's a factor of 8. Energy efficiency involves upfront investment, for example, for building renovation, and new financing sources are sorely needed, as well as innovative structuring. This is where some, actually many green banks are focusing their efforts. Next slide, please. So which technologies do green banks look at? Well, the most common sectors for green bank interventions are retrofits in buildings, rooftop PV systems, and municipal level street lighting. Particularly the first two are quite common. But green banks, as I suggested earlier, are not one size fits all, and green banks will pursue other sectors and activities. So, for example, the UK Green Investment Bank created the world's first offshore wind fund. The UK also has pursued deals in small-scale renewables, including onshore wind. Australia's CAFC has looked at concentrated solar power. Some green banks consider less commercial technologies, such as fuel cells, in Connecticut and New Jersey have explored these areas. And alternative fuel transportation and infrastructure, that's Connecticut and New York. So all of these are within, under the heading of low carbon climate resilient. But you also have some cases where they go beyond to broader green infrastructure. For example, California, South Africa, who we sort of downgraded over the course of the report as not quite being a green bank-like entity because they hadn't yet mobilized any private investment. They are more focused on grants, but in principle, they could be a green bank-like entity, and they've focused on water treatment, as has Malaysia. Switzerland, the Swiss Technology Fund focuses, among other things, on natural resource conservation. The UK looks at waste recycling and bioenergy. And so there's a range of technologies that green banks are looking into for the low carbon transition and beyond. Next slide, please. So looking at it, this is one of the core reasons why green banks are created, because there are investment barriers today. And this is an area of work for the OECD for a long time and many other organizations, looking narrowly at the way green banks look at the market. One concern is transaction costs, and for investors, the lack of investments with desired attributes. And for institutional investors in particular, they require large ticket items and the right risk-return profile, among other things. Aggregation is the solution for this problem to reduce transaction costs and bring the size of the transaction up to the necessary level. And as I'll give some examples in the second half of the presentation, but for example, loans for residential rooftop PV, retrofits of commercial buildings. And I should have mentioned the final element is securitization. And that's particularly to sell loans that are bundled through warehousing facilities to institutional investors. And securitization is a fancy way of saying transforming assets that would otherwise be illiquid into tradable securities in a prudent and judicious way. And it's important to add this after the financial crisis. And so there's always going to be added attention to how these transactions are securitized, and justly so. But it's a very important way to facilitate investment in this area. An important focus of green banks, as I said, is energy efficiency in buildings. I'm going to have more details in another slide on energy efficiency specific barriers and some of the deals and structuring approaches that green banks use. The second bullet here is on risks and lack of confidence in less commercial technologies. These days, with costs coming down so dramatically, it may seem that the lack of confidence is still part of the past. But in order to get mainstream large investors engaged in this area and ready for when project pipelines are ramped up in response to, in the wake of the climate agreement, it's going to be important to address skepticism among such investors. And one way to do that is through addressing risks and trying to accelerate risk-taking by investors. This is something that green banks are particularly focused on doing, including through demonstration, through co-investments, by sharing risks with investors using guarantees and other risk mitigants. And when I refer to risk mitigants, this is a term that we coined, a little clunky, but what they are is targeted interventions to reduce, reassign, or reapportion different investment risks. And these include guarantees, insurance products, other forms of credit enhancement, and taking public stakes. I mentioned demonstration, so there's the need to address incorrect perceptions, and demonstration aims to address these perceptions that clean technologies are risky and not fully commercially viable, also to fill data and information gaps and build confidence in markets. One example is the UK Green Investment Bank focuses on areas where its added capital, knowledge, and reputation can make the difference that enables a project to be financed successfully, rather than providing de-risking tools or concessional financing. But by putting skin in the game, the public sector can signal that a project has a level of viability and certainty that can provide confidence to private investors to co-invest. So I promised the organizers, I think it might be a good idea to pause now for a moment for questions, because that's a mouthful already, and it would be good to hear others who are out there. So I'll pass it back to Doug in case there are any questions.
Sure. Thanks, Rob. We have a few questions in. We'll go through them for you. There's one for me I'll save for the end. I think the question is, back on your map where I believe Masdar is on the map. Is that correct?
Yes.
What was the definition used to identify Masdar as a green bank?
There's one element of Masdar that focuses particularly on facilitating investment in technologies. So since it sort of addresses a number of objectives, but Masdar Clean Energy is more oriented towards addressing investment gaps and less on R&D. And so when we consider the core characteristics of green banks, it's the narrow mandate, their independence, and accountability. I will say that in some cases there's a gray area for which is a green bank-like entity, which is a green bank. I wouldn't overstate the importance of that distinction. I think that in the case of Masdar, they wanted to tackle a number of objectives in creating these related entities, one of which was R&D, another of which was to create a private equity venture capital-like entity to invest in non-commercial technologies. This is not typically a core characteristic of a green bank, but the fact that within Masdar Clean Energy they do have this more traditional approach, we included them under the heading of green bank. So hopefully that answers the question.
That's great, Rob. The next question is about sustainability accounting, again, the tracking of metrics of green bank performance. Do you have any perspective on how sustainability accounting is being considered by green banks in your report?
We surveyed reporting approaches, or more specifically, what were the performance metrics that different green banks used, and they're not uniform. I understand that the UK Green Investment Bank has been engaged in the last year or two in discussions with other types of public financial institutions to see if it's possible to promote harmonization of approaches, and this was a theme that was explored prior to COP21, the need to harmonize reporting approaches among, for example, MDBs, NDBs, and so on. I think that there's been progress in that area, and I think for green banks that will probably be one of the things that the Green Bank Network may explore going forward, and you'd certainly know better, Doug, but that seems possible. And more broadly on sustainability reporting, I think probably the first step for them would be to seek to harmonize among themselves what sort of performance metrics specific to their investments, and on the low carbon side, I think that would be a starting point. But then there's the broader sustainability reporting, ESG reporting issue, and so I think that's also relevant in this context.
Great, thanks, Rob. I guess we will do one of the questions on the network at this point. I think, first of all, yes, one of the areas of focus of the network will be to collect and harmonize, to the extent desired and by the members and possible, performance metrics, which is, of course, something which is going on across the green finance world, including in the area of green bonds. Another question about the network is, will the information collected by the network and being compiled be made available publicly? And the answer is that some of it will. There will be some things which will just be collected and collated and put in a central location on the website that relate to green finance that are already publicly available. And then there will be certain products which will be made available to the general public as determined by the members. So let's go back to your presentation, Rob, unless there's any other specific questions people have right now.
Okay, thanks, Doug. So taking a look at the different instruments that green banks use to invest, loans are very commonly used, and also bond issuances. And this is particularly important in the context of the growth of the green bond market. That's another topic that another subject of OECD research, and we'll be coming out with a report on the green bond market in October. One example here is NYSERDA, which is the parent agency of the New York Green Bank, issued a $26 million bond in 2013 to securitize a portfolio of residential and small commercial sector energy efficiency loans. And that bond used an innovative structure and federal tax benefits to secure a AAA rating. Another important and pioneering bond issuance was by Hawaii's Green Energy Market Securitization, or GEMS program. They issued $150 million in bonds to fully fund their initial capitalization. And this will be repaid using funds from an existing consumer surcharge on electrical bills. In addition, another example of an instrument is equity, and the Japanese Green Fund focuses on equity investments mainly in renewable energy. Looking at funds to pool capital, I mentioned earlier that the UK Green Investment Bank created the first offshore wind fund, and actually this might be obsolete. They certainly raised over 600 million pounds and possibly more from UK-based pension funds and institutional investors. The investors included a large sovereign wealth fund, and they pursue, for creating this fund and pursuing institutional investors, UK Green Investment Bank is pursuing what is called a wholesale strategy, so pooling capital to support a group of transactions. Looking at tools to reduce risk, these include, as I mentioned before, cornerstone investment in different kinds of guarantees, loan loss reserve funds. One example is Malaysia's Green Technology Financing Scheme. What they do is assess applications for green project certificates, and they provide certificates to eligible companies. The certified companies then seek loans from participating private lenders to improve lending approval rates and reduce risk. The program guarantees repayment of 60% of the financing provided to certified companies in the event of loan default. In this program, Islamic financing accounts for 40% of all funds granted under the GTFS. This is in contrast to the UK Green Investment Bank's approach for the offshore wind fund. This is a retail strategy, so it's supporting individual transactions like loans to support residential or commercial solar PV, often working with a local bank. Finally, we look at technologies to lower techniques to lower transaction costs, and this includes standardization of contracts, warehousing, and so forth. An example is the Connecticut Green Bank secured $100 million from a real estate investment trust in December 2015 for its CPACE program. This REIT purchased a portfolio of loans originally issued by the bank for energy updates in commercial buildings. The REIT can be considered institutional money as it is publicly traded, and as investment in REITs tends to be dominated by institutional investors. So this just gives a range of the sort of small retail and large wholesale approaches and different instruments and risk mitigants and transaction enablers that green banks are using. Next slide, please. A particular focus of the report is on energy efficiency, and green investment banks have been particularly innovative in this area. We at the OECD contributed to the G20 Energy Sustainability Working Group last year. A task group in this working group formulated voluntary principles for investment in energy efficiency, which were approved, and this is relevant to green banks because green banks are on the leading edge of actions recommended in these principles. So for this and other reasons, we put a spotlight on energy efficiency in the report. Some of the examples here that you see include on-bill financing, and one example is Australia's CEFC partnered with an Australian energy retailer to provide financing for energy efficiency upgrades in commercial buildings. Financing is then paid back as an additional line item on the building's utility bill, and this has the advantage of easing the repayment process for the borrower. It also provides additional security to the lender and enables longer terms and lower borrowing rates. This approach is also used in Hawaii. Moving down to the next example, the Connecticut Green Bank, their PACE program. The Connecticut Green Bank operates the state's PACE loan program, Property Assessed Clean Energy Loan Program, which is also common in many other states, but Connecticut has emerged as a real leader. Through PACE structure, commercial building owners receive long-term financing for energy upgrades. They pay the loan back as a new tax lien on the property. Attaching the lien to the property increases the lending security enables much longer term payback, making it easier to buy and sell property with an outstanding efficiency loan. The Connecticut Green Bank originates loans and builds a portfolio through warehousing, then sells it to private investors to draw in private capital that can only invest at scale. Looking at the final example, the municipal street lighting example, this is the corporate financing example in the chart. The Green Bank offers an innovative corporate loan facility to municipalities specifically tailored to allow cities to upgrade their street lighting to LEDs. And it's interesting that when you look at these transactions after they're structured and after the fact, you would wonder why all municipalities didn't sign up to do this immediately. But for some reason, it's extremely difficult to actually secure these deals. It takes a lot of work, and this highlights the importance of these pioneering efforts, and hopefully they can be replicated elsewhere. The LEDs save money for municipalities, more money than the cost of the loan payment, so borrowers can be cash flow positive throughout the period of the loan. There's fixed rates and terms matched to the payback period, and through this approach, municipalities are able to save 80% of their lighting costs by switching to LEDs, so it's quite a story. Okay, next slide, please. Another focus of the report is how green investment banks can be set up and capitalized, and this is aimed at providing this information to jurisdictions that may be interested in doing it, just understanding how they go about doing this. And this is obviously an area where CGC and NRDC have a lot of expertise. There's a variety of different mechanisms and legal structures, but often green banks are independent. And this is addressed in the final chapter of our report, which really focuses more on the practical nuts and bolts information on setting up and capitalizing a green bank. Capitalization sources vary, and you can see a few of the examples there. Having predictable sources of funding and recapitalization can be helpful to ensure sustainable organization over time and send a signal to private investors that the institution will be long-lasting. And so this is a challenge in setting up a green investment bank. But there's a range of examples, and it depends on the specific conditions in that jurisdiction. In some cases, where there was pre-existing funding for a maybe related initiative that can be beefed up by creating a green investment bank. Part of Green Investment Bank's focus, I mentioned, is on accountability and transparency. So there's a variety of reporting requirements when green banks are created, and as I mentioned before, it can include leverage ratio, return on capital, job creation, and so forth. Next slide, please. So stepping back and to give you a sense of why the OECD was interested in this topic and what we hope to achieve, and also some important caveats to stress. First, there was a gap that we sought to address, but we weren't aware of another comprehensive study of green investment banks. And this is an opportunity to examine their rationales, mandates, and activities. The objective was to be non-prescriptive and take a stock taking of how they're leveraging investment, provide the practical information that I mentioned before. A number of caveats. First, the report recognizes and actually emphasizes that green banks are not the only institutional option. It's worth noting that some national development banks have been providing financing for low-carbon projects for many years. An example is Germany's KfW. They've been active in mobilizing investments since the 80s in this area. And an interesting comparison is the Clean Energy Finance Corporation, which is, I believe, currently the largest green investment bank, is expected to be approximately $7 billion at their final capitalization. And Germany's KfW invested several times more in domestic promotion in 2015. They invested approximately $56 billion in 2015 in domestic promotion. Now, this includes, but is not limited to, programs to foster the use of renewable energy to increase energy efficiency and promote innovative technology companies. It's not exactly an apples-to-apples comparison, but in a report that we did earlier, we found that KfW had much more than US $7 billion in their investment in this area. So this is just to give you an idea that there's a range of institutions out there that are important, and some governments can consider mainstreaming green investments in their existing national development banks. Of course, multilateral development banks, bilateral development financial institutions play leading roles in mobilizing private investment. For example, in 2014, development finance institutions provided $49 billion in financing for renewable energy. So clearly, scale is an advantage for NDBs and MDBs. On the other hand, not all NDBs have a clear mandate to promote national climate change mitigation. And in the report, we briefly note issues for governments to consider in the decision between mainstreaming green investment in an existing national development bank versus creating a new green bank. Finally, with regard to their track record, generally, green banks have been around for approximately the last 5 years, roughly speaking. So their track record is still relatively limited compared to some of these other institutions, and our report is intended as a stock-taking rather than an assessment, but green banks are certainly very interesting for governments to consider as one potential tool they can use to mobilize investment in domestic low-carbon infrastructure and accelerate the shift to low-carbon investment. Next slide, please. So just to summarize what we've done along the way, we started looking at green banks in 2013, and our first Green Investment Financing Forum, which gathers institutional investors and public financial institutions, commercial banks, NGOs, and others, key stakeholders for a discussion under Chatham House rule on climate finance topics. We made green banks the subject of the first GIF in 2013. In 2014, based on our initial research on green banks, we held a green banks workshop with probably a number of the people that are on the call today, and with CGC and others, bringing green banks together, and also other institutions like NDBs and OECD and non-OECD governments who could be interested in these in creating new green banks. We launched a brochure summarizing initial findings at COP21 in Paris, where we also, I think Doug mentioned that the Green Bank Network was launched at this event. We're very happy to have them with us there, along with a number of other important stakeholders. The full report was launched in May at the event that Doug mentioned at the parallel to the Clean Energy Ministerial in San Francisco. And looking forward, we're going to be holding the third annual OECD Green Investment Financing Forum in Tokyo in October. And there we're looking forward to holding a session on green investment banks, and this will follow a Green Bank Congress that is being organized there, and we're looking forward to seeing some of you at that event. And with that, that's my final slide. So thank you very much for your attention, and if you have any questions, I'll be happy to try to answer them now, or if you'd like to follow up separately, that would be great too. Thanks.
Thanks, Rob. We do have a few more questions in the queue here, so we'll take in over the next few minutes. The first one is, in your research or in your knowledge, since you've been conducting the research, are there any emerging market countries looking at green bank development?
That's a good question. At the same time, I might flip it to you, Doug, because I know that you're looking at this carefully. But I would go just briefly back to a comment I made on South Africa's Green Fund. So at least in terms of the description of their objectives and their funds, they have a fund for greening cities. A lot of their objectives are very much in line with what green banks do. They are quite grant focused, and that is so to the extent that they move away from exclusive use of grants in the future towards leveraging limited private money and trying to use loan guarantees and other instruments. There's another potential partner, but maybe Doug, you have some other examples.
I think the one that we're most aware of and frankly very excited about is in India, where there's as you said, Rob, a lot of the national development banks, like KfW, have been doing in this space for a long time. And one thing that is maybe not well known is that India actually has had an entity since I guess the early 90s, also focused on clean energy lending. But that, as you mentioned in the South African context, it's more of a GIB-like entity. It has done a lot of lending to the solar sector, some wind, but has not been focused on crowding in private capital. So currently, we're aware that there is some interest in India to expand the mandate and the set of tools that this existing entity, which is called IREDA, can use to catalyze investments in India, given that there's a very ambitious target that's been set by India to achieve deep penetration of solar, wind, and energy efficiency by 2022. So that process is underway, and we hope to hear more news about that later this year. Also point out
Doug,
there are entities. Yeah, go ahead. Yeah.
I'm sorry, but when you're done with India, I just want to say a couple of things about China.
Sure. Let me just say one more point. India is one. And also, as you know, there's in Brazil, there's a national development bank which has been very active in clean energy, but again, not very catalytic. And there's, and I think we're getting more and more inquiries from all around the globe about this new tool. And we expect to see more as countries look at fulfilling their Paris commitments and need to really bring in more private capital. Go ahead, Rob.
It just occurred to me after we started talking that I'd be remiss not to mention China. So the China Council for International Cooperation on Environment and Development, long name of a council, they recommended the creation of a national green development fund, and this was something that was accepted in the 5-year plan. But the future of it still remains to be seen, but at least it was intended to provide equity investments to facilitate access to other financing, including bank loans, and to focus on areas like renewable energy investment, industrial pollution control, and advanced vehicle technologies. So, a question is how this proposal could develop in practice, whether it will focus mainly, if it's implemented, on low carbon investments, or will also look at remediation, which is another big investment need in China.
Thanks, Rob. I'm going to pick some more questions out of the queue here. Here's one about setting up green banks. We can probably both win on this. I'll let you go first, Rob. What are the most important factors to get right in an initial green bank setup?
Well, I'm glad you volunteered to follow up. The impression, since you're so directly engaged here, and as a CGC, I would just repeat something I mentioned before, which is sort of stability of funding sources. That's the first one that comes to mind. Some green banks have sources of funding that renew every year, like Connecticut has funds coming in, I believe, from the REGI program each year. If you have other sources that are subject to change, that's problematic. Bond issuance is a particularly innovative area that I think it's an interesting model to consider. New York also uses emissions trading scheme revenue, and then there's sort of large capitalization up front and over time. So I think the Australian program had capitalization over time. The question in all of these is whether it's sufficient and whether it's predictable, and so that's what I would highlight.
That is probably the most important factor. I would also say that doing extensive market research with all stakeholders, including, one concern which you find is that the commercial banking sector sometimes is concerned about green banks competing, and it's really important to make sure that there's sufficient outreach to explain the purpose of the green bank. It's important also to have, as you said, it's sort of implied by what you said, the proper legal structure to allow independence and allow to do things like form SPVs and issue bonds. That's really critical to be able to have all the necessary powers to operate effectively. I'd also say that it's been shown that it's critical to have the right people in place in the institution with the right backgrounds and training, because it's a different skill set to make grants or even traditional lending in some cases than it is to try to do market transformative work. I think those would all be sort of critical factors to putting together a green bank effectively and in a timely fashion. Okay, go back to the list. There's a question here, Rob, about, you talked a bit about the differences between green investment banks and national development banks, and this question concerns is there any, at this early stage, is there any kind of data or indication as to whether or not development banks acting in a green capacity are more or less efficient than a green bank, operating as a dedicated entity? That's kind of a speculative question, but what are your thoughts on that?
It's a good question, and one that we thought about, and actually that this China Council, when they were looking at the topic of green investment, they were interested in this question as well. I would just say that this is for future research, and governments are going to be looking for the most efficient ways to mobilize investment. In the report, we do talk about some of the, advantages and disadvantages of creating a green investment bank versus mainstreaming green investment in existing NDBs. And one issue is that NDBs have a broader mandate and range of objectives, and this can make it more difficult to get the same results and extent of sort of exclusive focus on green investment that green investment banks have delivered because of their narrow mandate. So that's something to consider. And the flip side, NDBs have the advantage of scale. That said, it's also important to note that there's an interesting opportunity for green investment banks to work with and potentially partner with MDBs and NDBs. And in discussions at a workshop that we held in 2014 that I mentioned, one MDB stressed that they saw green investment banks as being particularly nimble and innovative and effective, and they also have local expertise that's potentially very valuable for MDBs and even for commercial banks who are global but can't be everywhere. And green banks focus on the very specific barriers that are faced by local existing and potential investors. So there's this potential to partner with other types of institutions and even to get capitalized by other institutions. So this possibility was brought up at our event at COP21. We had somebody from the Green Climate Fund who raised this possibility of GCF capitalizing green investment banks or central banks capitalizing green investment banks. So this at the time was speculative and in the realm of what could be done, but potentially an area for green banks to look at more carefully to help overcome this challenge of scale, because they can be very effective at the local level. And one option is to create green banks all around the world. And Doug is doing great work to help do that. And another option at the same time is to figure out how to build scale and take advantage of existing expertise.
Thanks, Rob. And I'll just add to that. I think one of the focal points of the network is to, as I mentioned earlier, to create partnerships with other sort of fellow travelers in the green finance space. And so the network, has reached out and will continue to try to find opportunities to collaborate, because there's a long experience of efforts in these markets, and there's some convergence. I mean, I think a lot of the NDBs, have, as you said, deep local expertise in working with local lenders and really looking at local challenges. They may not have all the expertise to underwrite these assets, so there's fruitful collaboration there. And then some of the larger MDBs have a lot of experience doing large projects, and there's maybe less experience doing distributed projects. And I think the green banks are really at the forefront of the distributed energy framework, and I think that they're moving very quickly. They have the ability to experiment. I think there's a lot of opportunities for cross-fertilization and learning on both sides. So take one last look at the question queue, and I think we're going to start wrapping up with any kind of final thoughts that you have after this next question. There's some questions generally about are the green banks reaching out beyond sort of both, on the one hand, pure energy investments, looking at social investments, and are they looking at things like resilience investments? I think, Rob, you answered part of that. I'll give you my thoughts, and you can add in anything you'd like to at the end. I think, the New Jersey Resiliency or Sustainability Bank has looked specifically at resilience. And I think you're also seeing the green banks working in projects which have a social component insofar as we're talking about low-income communities. New York Green Bank has been exploring investing in low-income multifamily housing, for example, and there's projects like that. Some of the green bank-like entities are already investing in, as Rob mentioned, in things like water infrastructure, and we may see more of that. So I think, and then if you look at on the green bonds side of things, as Rob mentioned, green banks have both been issuers of green bonds, and then the CEFC Australia actually purchased some green bonds in Australia. So there is some innovation going beyond both traditional markets and also looking at different classes of investments, including, and I think we also mentioned, Rob mentioned, there's been a large amount of equity investment in the UK, looking at the offshore wind market. So there's equity, there's debt, there's long-term, short-term construction, long-term capital, and there's also looking at harder to reach markets. Anything to add to that, Rob?
Just a couple of things. So in terms of social investments, one goal is to try to expand investment in distributed generation and energy efficiency to lower and middle income households, and that was a goal of the GEMS program in Hawaii for solar PV. In Japan, a lot of their focus, as I mentioned, is to help develop community development in local communities that were affected by the tsunami, and to, I think, create at the same time increase mitigation and deployment of renewables and energy efficiency in these communities, but also at the same time making them more resilient and energy independent in some of the rural areas. And then in terms of social investments, one item that came to mind is Connecticut Green Bank as one source of investment. They used crowdsourcing, and so that's sort of a different but related topic and important in the social investment sphere, and they provide the opportunity for individuals to invest in their deals. I forget whether it was energy efficiency or renewables, but there's some pioneering activity there as well.
That's wonderful. So we're at 12:11 in New York time. Later where you are, Rob. Do you have any questions, any thoughts you want to add that haven't been covered here to conclude the conversation?
No, I just thank everybody. Again, if you have any questions and want to find out more about the report, there's the websites that are listed on the final slide. So thanks again, Doug, for the opportunity.
Thank you, Rob, and the OECD for the incredible presentation and discussion and the new report. I encourage all of you to go to Rob's website and check out the report. And thanks to the audience for all the great questions. If you have further questions, and we'll make these, well, first of all, make the slides available and a recording available on the website, greenbanknetwork.org. There's also on that website an info email for questions, and be sure to sign up for the Green Bank Network newsletter. On behalf of the Green Bank Network, CGC and NRGC, thanks for joining today, and have a great rest of your day.